Hi, I'm Paul Baay. I'm CEO of Touchstone Exploration. We're a public oil and gas company traded on the Toronto and London AIM Exchange. Our only assets are in Trinidad, which is the neighbor to Venezuela, the up-dip end of the Venezuelan Basin. We are the largest onshore producer, independent producer onshore in Trinidad, producing both natural gas and oil. And in the last few years, our major focus has been to bring on some big natural gas reserves that we discovered back in 2019.
Fantastic, Paul. Lovely to meet you. Right, we better start off with you. Who are you? What have you done that's relative to what you're trying to do here?
Yeah, so I'm CEO of Touchstone, and I've put together two other companies previous to this, and I've been CEO of those. I'm sort of build them up to a certain size, and then they got sold. The first one was about 150 barrels a day, and when we sold it, it was about 25,000. And the second story was very similar to that. They were both Canadian-based companies with Canadian assets. And after the last company that I sold, I took a little bit of a hiatus, a little bit of a forced hiatus because I had a non-compete with the company that we had sold to. But it wasn't an international one, so I took a look around and basically found Trinidad as an opportunity with big oil in place, good infrastructure, good place to sell in the market, and started there. And we picked up about 130 barrels a day of base production, and that's how it all started.
Okay, and talk about some of the majors already in play there. So who are the companies that we could look to?
So there's sort of two classes of assets in Trinidad. There's the onshore assets and the offshore assets. And the offshore assets are all by the majors. So that's BP, Shell, EOG, Woodside. And these are big offshore platforms, mainly gas, but oil and gas. But they're big. But when you come onshore, you get into, basically there's none of the onshore, the big players are onshore. The one that was left was Shell. They had one plant, but we're taking that out here in the next month or so. But all the rest are sort of the smaller players onshore. And we're really the largest public company onshore. And that's kind of what we've carved out as this niche of wanting to be the biggest onshore player.
Right, and in terms of onshore, in terms of regulatory and environment, etc., I mean, social license, I guess, as well. And what's it look like in Trinidad?
Yeah, the one thing about and part of the reason why I ended up, starting again in Trinidad is it's a country that's a very oil and gas based economy. So it's got an LNG plant, it's got petrochemical plants there, but most importantly, its economy is driven by the oil and gas. So it's actually a very welcome place to be. And if anybody takes a look at the energy minister currently, who next month will actually be the prime minister, he's on record saying that, we are open for business. We want to produce all the oil and gas we can in Trinidad. So philosophically, it's a wonderful place to be. Regulatory wise, they've been producing oil and gas since like 1908. So it actually has a very high degree of regulation. The downside of that is it was a British colony until 1962. So there is a lot of process in place, and sometimes that takes a little longer than we would like. But I think that it functions very well. But it's also, in British law and everything else. So there are some big upsides in that for sure.
We do have a lot to answer for. I apologize. Right. Let's talk about the rest of your team. Who are you supported by?
Yeah, it's a pretty small team in the Calgary office, which is our head office. There's about 16 of us. Scott Budow, who's our chief financial officer, he's been here for over 10 years. He worked previously at a service company and then came over to work here and worked his way up from BP Finance into the role that he's in now. Brian Hollingshead, who's our executive VP of the engineering side, really interesting background. He was an engineer at a number of companies. Then he went to the capital markets side, worked in the capital markets side with a substantial Canadian firm, and then also has his MBA. So it's a really nice balance with him. And then James Shipka, who's our Subsurface, HSE, and quite frankly, our coordinator of a lot of our M&A, worked for a number of companies here around town. So that's it. But I think what's more important is the way we've structured the company is in Trinidad, we have no expats. It's one big organization that all reports, reports through to everybody. And it because we only have one country that we produce from and sort of not multiple companies, it really feels like one big company when we report up.
Okay, well, and talk to me about lessons learned from your previous experience, because I want to get into the assets in a second, but this plan, how do you go about building a big company like you've done in the past? What's important to look at?
Yeah, I think that's really key. And it's exactly the same model as I've used in the past. The only difference this time is it just takes so much longer to do things internationally. And Trinidad is even more challenging, and some of it's, located in the jungle and all those other great things. But the three stages are getting the land, which I sort of refer to as the oxygen. It's where your inventory comes from. And then the second part is taking control of the infrastructure, so that as you bring on new plants, or sorry, not new plants, new wells, they can immediately go to production. So, like right now, we have two gas facilities. The third one will be this one that we're picking up from Shell. And to be honest with you, it's world class. It's much bigger than anything that we have right now. But those are the only three gas processing facilities onshore in Trinidad. So what that'll do, again, is give us full capacity of everything that we've got. And then the final component is you just drill the heck out of everything and fill up these facilities. So we're right at that flux now of where we've got the facilities, and now we got to start getting the drilling going and basically convert the reserves to cash, which is the stage that we're at right now.
Right. Okay. Drill the heck out of everything. That means you got some data. So what did you pick up?
Yeah, and the data is really, that's one of the advantages of Trinidad is like BG was in here before they got bought by Shell. They shot a huge 3D, and then Talisman was in here back in right around 2000, 2002. They shot a huge 3D. So the one advantage we have here is we can compress the timeline on the drilling because we don't need to shoot any data. So the government, we got all that data for $30,000. It's probably 60 or $70 million worth of data. We're reprocessing it right now, which is $500,000, and then we can then put together. But we've already looked at it, so we've already got an inventory. More of this is sort of high grading and making sure we're in the right spots.
Okay, and then how are you validating that data? What additional work do you do?
So it's a combination of both using well data and the seismic. So basically what we're doing with the 3D is running it through some new programming, actually running it through some AI programming as well, which is a combination of production, wells, and the data, and looking at it and looking for both development opportunities in existing pools, which, should be lower risk, as well as looking for exploration opportunities. And, if you look at our report, we've got 229 drilling locations, and we can drill about 20 wells a year. So that kind of gives you an idea of how we can high grade the inventory as we go forward.
Right. And obviously increasing certainty around that's important. So, recalibrating, reinterpreting, and reprocessing data is one thing, holes in the ground is another. So how does that kind of certainty build up as you start drilling?
Yeah, so there's two things that happen. One is there's a tool that you run down the well when you drill. It's called a sonic log, and it allows you to tie directly to the seismic. A lot of the wells that have been drilled so far don't have the sonic. So as we drill more wells, we'll do that, and that'll give this better tie and correlation with the 3D. So that's number one. But number two is just the fact that you can apply new technology. And the advantage we have in Trinidad is there's been like 15,000 wells drilled on shore. So then you integrate that data into the old well bores, and you get this really clear picture of what you want to do. And the other thing is, in this bid round that went a year ago, it was the first time the government had ever let you look at all the seismic that was available. They always get one copy of it, right? So they made it to the public. It's the first time we actually saw geology, subsurface for the entire southern part of the island. Kind of, you can imagine you've been looking at these little sort of pixels, and now you get this whole view of what's going on there. So, over the last 14 months, I think the whole view of that southern part of the island has changed. And that's why we were so aggressive on the land picture.
Right. And I guess the other component here is, I guess, the cost of doing business in country as well. How's it compared to other jurisdictions?
The cost of drilling and things like that, was that the question?
Yeah,
Sorry.
yeah. And the infrastructure and basically the OpEx. What's that look like?
Yeah, so the OpEx is a bit unique because the two companies that you sell to in Trinidad, your gas goes to the National Gas Company, and Heritage, the Crown Corporation, buys the oil. They all buy it right at the wellhead. So what that means is there's no transportation and there's no processing except for your cost to get it to the wellhead. Give you an idea, our oil costs are roughly $14 a barrel, and our gas costs are probably 5 to 6 cents per 1,000 cubic feet. So they're virtually nothing
What's the net back then on that? I don't know what the payables are.
Yeah, so on the gas side right now we've got a fixed price gas contract, and that roughly runs, call it $2.50. You take 12.5% royalty off of that, and you take, the 5 or 10 cent operating costs off of that, and everything else is ours.
Okay. And obviously, the more you produce, the more efficient you become. So, what does it look like today? And what's the end of 2025 look like for you? What are you aiming for? What are you guiding?
Yeah, so we've guided for about 7,000 BOEs a day this coming year, and the thinking on that is we're starting out with lower production as we drill these wells. Then we'll go ahead and ramp that up. We're also picking up this shell plant that I talked about, and when we pick that up, we also pick up 2,000 additional BOEs a day of production. So that's going to close in the first half. We're hoping it closes in early April. So we have revised guidance out that'll obviously, layer on that new layer of production effective whenever we get that deal closed. So there'll be some additional guidance, update on that. But really what the end of the year is going to look like is it's going to look like some development on our one big gas pool, which we call Cascadura, the roll in of the Shell property, and then kind of sets us up for 2026.
Right. What's the balance sheet look like in terms of cash at hand? How you're allocating that capital? When obviously you're quite aggressive on the revenue side of things as well. So how does the next 2 years look like?
So the balance that we always try to do is we're trying to basically spend the cash that we bring in right now. So we take a look at where the CapEx budget's going to be, and then where the cash flow is going to be, and then basically spend that money. Now it's kind of a little lumpy through the year. So we also have a $10 million line of credit that kind of goes up and down with the bank so that we can manage that. But at the end of the year, we're going to be roughly around 30 million of debt, and then we'll add on the addition of the Shell facility. But the way we do those is we pay them back. We pay back over an amortized 5-year term loan, and it gets paid down quarter over quarter. Our target is always to be about 1 to 1.5 times debt to cash flow. That'll balloon up here a little bit when we buy the Shell assets initially. And then that'll come down as we move into early 2026.
With the debt facility with the bank, is that Calgary or are there Trinidad banks?
No,
right capital.
It's with Trinidad Bank, and there's a couple advantages. I think from a social license point of view, it's great to be able to do it in country, but also because the funds are sourced in Trinidad, we can actually deduct the interest in Trinidad. So our cost of capital on that is going to be about 7.5% to 8%. But by the time you do an after-tax basis, 4.5% to 5%. So it's very efficient cash for us.
Okay, that's really interesting. Actually, with regards to the assets themselves, obviously it's all relatively new, and things moving through really, really quickly here. But are there other opportunities in country as well once you get this thing moving?
Yeah, there are, but I must admit, it's kind of like we own, an island in the Caribbean right now with what we've got set up with the land base. As I say, we were aggressive on the last bid round, and we basically picked up all the land in the fairway from the west to the east part of the island on the fairway. So to be honest with you, there might be few little things to pick up, but there's nothing big left. I mean, if you go back a year ago, I had referred to the Shell property as kind of the holy grail of Trinidad. And for a couple of reasons. Number one is it's a beautiful facility located right in the heart of the fairway. But on the takeaway from that plant, the key thing is it goes to the petrochemical business, which they call the domestic business, which is what we sell to now. But the most important thing, and what really changes with the Shell deal, is it allows us now to go to the LNG market. And we'll get LNG pricing for that gas. And that sort of phases in over the next year and a half. But, to give you a magnitude, we're getting $2.50 right now, and LNG selling for $12 or $14, right? So there's a little processing to get it there and all of those kind of things. But the magnitude of change here, I'm not sure has really been grabbed by the market yet. And maybe after we get the deal closed, everybody will start to see some of those opportunities. But that's the fundamental change that's going to happen for us in 2025.
Okay, that's really interesting. And in terms of the technical aspects, the drilling depth, reservoir characteristics, is it really simple drilling, or do you have technical challenges there to overcome?
No, it's not. And as a matter of fact, if when you look back, we've had a lot of wells we've had to sort of scrap halfway down and do a sidetrack and go around. And part of it is the rock is very young coming off of South America. So you get these swelling clays that kind of choke up the wellbore when you're drilling it. It's mainly above the zones. Once you get into the zone, it's okay. It's kind of getting there. So there's been some technical challenges on that. And the other challenge, and quite frankly, it's, part of one of the reasons we're in a bit of a penalty box right now, is these wells have huge initial flush production, and then they kind of turn a corner and level out. And so, you get these sort of spikes in the production base. And I think it's difficult, I think, if you're not in the business, to understand sort of how these declines work. It looks, it's pretty standard when you look around, but once you turn into that parabolic section of the curve, you're going to be producing for 15 or 20 years. It's just that initial drop off initially is really challenging.
And how? Can you get into a bit more technical detail on that in terms of, like, obviously these initial flow rates look great, and then they sort of drop off to what? And how does that kind of flow down expansion sort of managed?
Yeah. So what we see two different flow metrics in the rock itself. So what you see the wells acting like it's been fracked, and really it has been fracked, because when the tectonics came along, they pushed all these rocks up, and that's why they're as great as they are, but it's busted them up, if you can imagine that. So when you open them up, you get these really high flow rates. You basically get rid of all the gas that's in those fractures, and then the rock itself starts to feed in, and that's where you turn that corner, and it's what we call matrix porosity. Once you get into that matrix porosity, you get this nice long linear flow out of it. But, to give you an idea, like the first year declines could be 70%, but you're bringing the well on at 40 million cubic feet a day, and you get all your money back in the first 5 or 6 months. And then everything after that becomes the profit. So that's the new model that, it's been a bit of a challenge to kind of get our heads around it. There hasn't been any new gas wells on the island in 20 years, so it's not like we had a bunch of modeling to do here. We were flying a little bit blind on what we did. But what we're now seeing is the two first wells we brought on 14 months ago, they've made that corner. They're right on the curve. The new wells, as we bring them on, are going to be exactly the same way. So
right. And what do you expect the sort of average EUR to be then for each well?
So that's going to, I think what we're going to look at right now is we're kind of modeling them off of what we'll call our P90 case, so the most likely. So we're looking for something that comes on about 14 to 17 million cubic feet a day. And then when it finally turns that corner, it's going to be between 8 and 10 million a day. So that's those are the kind of numbers that we're looking at right now.
Right, and obviously you're kind of feeling your way through. I think the Cascadeur 4 well was postponed last year and into this year. You glad you made that decision? Did that kind of get a bit more certainty about what you're going to be able to do there?
Yeah, I wish that was sort of a decision that we made all on our own, but Mother Nature helped. There's a bridge we had to build, and it was a bridge too far. It took months and months and months with the rain, and we just couldn't move the rig till the rain got done, and it's in there now, and it's actually shut down right now just because they had a problem with one of the pumps. But when that gets fixed, it'll be back drilling.
Right.
Probably in the next couple of weeks.
Right. Okay. And with these kind of Cretaceous plays, they're all described as like high potential. Again, with the historic data that you've got, seismic, legacy wells, etc. What's your expectation in terms of managing those fields?
So yeah, you're talking about the Cretaceous, which actually lies below everything we've drilled so far. So we've been drilling up the Herrera. That's been our main focus. We now know with the science that we've done is the hydrocarbon that's in the Herrera has been sourced from the Cretaceous. It's actually, the kitchen is the Cretaceous, if you want to think about that. Mm-hmm. Now, having said that, Talisman came here and Exxon's both come to Trinidad looking for the Cretaceous because it is the big play. It's bigger than anything that we've looked at. It's what Guyana and Suriname are chasing right now.
Those are offshore, right?
It's all offshore, but that basin is offshore, but that whole basin comes right through Trinidad. And there have been a number of Cretaceous wells drilled. I think there's been almost 30 drilled in Trinidad, none of them being successful. But they were all drilled on the same old model that the original dry holes were drilled at in Guyana, which is structural, a model. When Exxon came into Guyana, they started to do stratigraphic models in the Cretaceous, and that's worked. I think they're 14 out of 19 or something on their discoveries. So what we've done is taken that technology, brought it to Trinidad, and that's now where we're looking at taking the dry holes that Exxon and Talisman drilled with the 3D seismic you and I were talking about earlier, processing that for the Cretaceous, and we think there's probably 3 or 4 really interesting Cretaceous shots on our land. The nice thing is the Herrera sits above it. So if we get a good Herrera well, we can take a bit of a shot down to look at the Cretaceous.
Right. And I guess the good news is that you're onshore. I was talking about onshore here. That said, I mean, how do you manage the timing of this? Because do you want to be self-financing? I get gas flowing shallower, and then kind of get into sort of capex requirements for these sort of deeper plays?
Yeah.
Or do you go and raise some money for it and get after it quickly?
Yeah, the short answer is a yes to the self-funding it.
Yeah.
And really what we want to do is we've got these 3 gas plants. They're all underutilized. We've got the land. We've got the rig. We just want to drill development wells into those. And then what we can do is we can then do going forward. And what we're likely want to do in 2026 is take about 80% of the capital, make that development, and 20% exploration. And then that would be the break going forward and have that self-funding. So, we talked about the debt load being a little high at the beginning, and that's really where Scott's going to just manage the capital and the debt load. And then when we go into 26, this thing starts churning out enough capital to be fully self-funding.
Right. And what do the markets look like? You talk about, obviously, you're selling all in country when it comes to the gas, and you've also referenced maybe some premium LNG pricing, et cetera. Again, how do you kind of get that balance between where you're selling to and what pricing you're going to be able to achieve?
Yeah, so right now, demand on the island, if all of the petrochemical business is running and all the LNG trains are running, is about 4 billion cubic feet a day. And right now, they're at about 2.3 billion cubic feet a day of supply. So there's this huge gap. So we sell every molecule every day. There's never a problem with that on the natural gas front. The change that happened in October 1st of last year was the LNG plant became a common carrier. It's a little more complicated than that. But basically what it does is it allows third-party gas to now go to the LNG facility. Before it was just Shell or BP. So that's opened up that market for us that never existed. And that's quite a game changer when you look at the LNG price versus the petrochemical price. So, but we can sell to either market. You still have to sell to the aggregator, which is the National Gas Company, and you negotiate a price with them. But that negotiation's now changed because you can either sell LNG or domestic, and they supply both. So we're gonna look at the pricing on that. And oil, we get Brent less about 15-16%, and that's just bought by the Crown Corp, and they send it out to one of the other Caribbean islands to be refined. So it's from a marketing point of view, we get paid in US dollars. We get paid on the 25th of the following month. It's a dream from that point of view. The only challenge is on the gas side, there's always a couple of middlemen that take a little bit, mainly the Crown corporations. So you don't always get that sort of Henry Hub price you'd like to get or the full LNG price. There's always a discount to that.
Right. And in terms of the, I guess, allocation of capital, we've talked a little bit about, what your hopes are this year. You've got legacy oil fields such as Balada East, etc., which continue to produce. How do you assess them for optimization? Because you could be talking about recompletions or artificial lifts or enhanced recovery, etc. with those, or you can get after the new stuff. I mean, what's the best use of capital for you when it comes to getting money through the door?
And that's what we do every day around here is look at that cost of capital, right? And stack those programs up, comparing those oil prospects to the gas prospects, risk them, do all of that. The one thing about those legacy oil prospects, though, is there are some commitments on it. Like there's a couple wells a year that you have to drill to keep the land. So those are obviously just built into the program. You have to do those as a minimum. But if you look back at the last 10 years, like that production's been unbelievably stable when you look at it. So it's kind of a nice, I'll call it a base production. And the other part is because we've got the fixed price gas contract, it's basically a hedge for 70% of our production, right? Because it's a fixed price contract. So by having the oil at world price, it moves around and still gives investors an opportunity to, take advantage of a higher or lower oil price as we go along.
Okay.
So it's kind of a combination.
Okay. And what about in terms of, and you talked about the extent of the land package that you've got. Do you have any sort of non-core assets, and would there be buyers even if you did?
Yeah, so there are some non-core assets. Like we've actually disposed of 4 small properties in the last couple of years, and you really, it talks what we were just talking about a minute ago, which is that capital, right? Like we're going to drill a well for 50 barrels a day when we can drill a Cascadura well for 3,000 barrels BOEs a day, right? Like that, it doesn't make sense. So what we did do is dispose of 4 of the small blocks, and we'll probably have a couple more small blocks to go to kind of clean that up and tidy that up a little bit more. But that's the plan, is to just focus on the best rate of returns. As far as buyers, to be transparent, they're local buyers. So one of them was actually a drilling company, and we took half cash and we took half drilling credits, which is fine because we can use the drilling credits to drill, right? So it's sort of a win-win, and from a social license point of view, again, it's kind of nice to keep it on the island, right?
Okay, and again, coming back to like you've been there, done it before. How do you view exploration drilling versus development drilling in terms of that capital allocation?
Yeah, and I'm a bit of an explorationist. It's I think that's probably where you still see the greatest value creation for shareholders. If you get a big exploration opportunity, those are the ones that are nice. The balance perfectly would be a 20% exploration, 80% development. So what does that give you? That probably gives you 2 or 3 exploration wells a year to drill. And when we look at, the number one on our list right now is the Sapero prospect, which just sits north of our existing properties. It looks like a lookalike to Cascadura. It's right in the window. It could easily be tied into Central Block. It's non-contracted gas. And quite frankly, it's kind of where the Cretaceous is coming up structure onto the Central Block. So we could actually take a shot at the Cretaceous there at about, well, I'll call it 10,000 feet, which we've already drilled to before. Whereas as you move south, we're getting down to 14,000, 15,000 feet. So that is a well that I really want to drill, but we just got the land. It takes about 9 months to a year to get the CEC, which is the environmental approval, and then move in there. That's why I say I'd love to be on that in January of 2026.
Okay, exciting times. So what are the in terms of the risk management side of this thing for you for 2025? What have you instructed your team to focus in on?
So we've really got 2 projects we're focusing in on. One will be development drilling at Cascadura. So the initial budget has 4 wells in there to drill into the Cascadura facility, and that's really just to optimize that facility and get it up to a volume that we like. And then the second part is as soon as we get the Shell property, it's had nothing done on it in 20 years. We're going to put in place a 3-phase plan for Shell. One is look at the existing well bores. We think there might be some recompletion, some optimization of that. Number 2 will be to drill a couple of development wells there. And then the third part will be to bring any third-party gas that's sitting on the edge of the property into the plant so we can optimize it. So that's the simple answer of what we're doing this year, is development drilling at CAS and ramping up the Central Block as soon as we've got it.
Okay, so focus on the kind of lower risk drilling with the potentially higher yields sooner to reinvest back into getting after the deeper stuff. Okay, fantastic. Well, Paul, really nice introduction to the company. Tell me this: out of all the places you could have chosen to work, why Trinidad? Why point yourself there?
Yeah, I did a little looking around, and I think there's a couple of reasons. But it really started with the rocks, and that's when you look at that up-dip end of the Venezuelan Basin. The Venezuelan Basin's the most hydrocarbon-rich basin in the world. And when I looked onshore, it kind of fit the model of what I had done with the other 2 companies I've been involved. You can go in, you can get a small toehold, you can do some acquisitions, you can do some land deals, and you can build this package. And what I really liked about it is there's no competition on the island. Like, there was no other public companies that were there. And part of that was the fiscal regime is a little tougher than it is in other parts of the world. And part of it is I think a lot of people get frustrated there because of the process. And we've just kind of put our heads down and pushed our way through that. Now that we're through all of that, there's a barrier to entry for everybody, right? Like it's a great place to be in that there's not a lot of competition for us to be there. So, and quite frankly, the previous places I had been were 2 companies had our fields were in northern Canada, and it's a lot nicer to go to Trinidad in the middle of winter than it is to northern Canada. So that may have had something to do with it too, but we'll keep that between us.
Okay. Well, appreciate your time today. Thank you very much.
Thank you.